So is this all because of just how much cheaper it is to invest in passive and ETFs?
Yeah, absolutely. What you're seeing is a very, very big shift because investors have realized, why do I need to pay lots of money for an active manager who's actually not potentially beating the market? If you look at the markets this year, S&P is up to 19%. That's not something many stock pickers can really achieve. And especially if they cost a lot more money, the real question is, if they're not beating that benchmark, why should I pay?
A lot of them have been changing their models, though. I remember asking this question of Bill Ackman, of all people, and he pointed out that obviously he had started something completely different with the actively traded shares in London, for example, and other managers as well. I mean, it's a long time since we've seen 2 and 20 even, isn't it?
Sure. I mean, I think what's happening is that many active managers, especially at mutual fund companies like Fidelity, which is known for its stock picking, are going to lower their expenses to try to really, really lure in investors. But it's so much more expensive to actually buy a fund that's active at a Fidelity than it is to buy an index fund at a place like Vanguard. And when you look at the ultimate performance of a Fidelity fund, active fund, many of them have not been doing that great. Some are doing great. But index funds now are pretty big of a place to be because you're just marking the market and you're basically saying, hey, I'm making 19%, not a bad deal.
But that's great when we continue to see a market rally. But what happens if you see a downturn? Because those stock pickers could come to the rescue.
It's possible. I mean, I think the issue here is people have been lulled into this sense of security with the markets. I'm making a lot of money. I'm not doing a lot of work. If I have an index fund, it's doing set it and forget it. I just leave it alone. That's a big risk. But stock picking really is about good ideas. And ultimately, stock pickers really have to show that they have great ideas that can exceed the market. And as one money manager told me, can you really have 50,000 great ideas a year? Because that's how many managers are out there trying to really come up with ideas for stocks.
Yeah, I mean, it's the old story, right? If you're not one of the elite few, you won't get in with the elite manager, and therefore you may as well be in something passive. At what point is there too much money to manage? So Brevin Howard, for example, didn't have to downsize. Obviously, it was forced to downsize a little bit, but it had been considering downsizing anyway, right?
Totally. Both mutual fund companies and companies like BlackRock and even hedge funds are saying, listen, we can't manage some of this money at the pace at which it's coming in, especially hedge fund managers. People like BlackRock are saying, hey, we can take as much money in as possible. But the real question is, can they really continue to do that if the markets actually crash? But fund managers are realizing, hey, how can I have now a portfolio manager who's managing 10 million or 10 billion actually. So it's a lot of money, and the choices that you make as a money manager now are much more fraught.